Hello everyone, my name is Chris Titley and welcome to the Fintech Australia podcast. The Fintech Australia podcast takes listeners on a deep dive across the fintech industry in Australia, focusing on the challenges, opportunities and big stories our community faces. Let's get to today's episode. Hi, it's Chris Titley here. As part of the Fintech Australia podcast, I'm joined by Anto Joseph, co-founder of Stropro. Is that how you correctly pronounce the name, mate?
Yeah, it's Stropro.
Stropro. A little bit tricky, but all good, mate. Today we're going to be talking about alternative investments in an uncertain environment. Certainly has been a wild couple of weeks, and it's good to grab you now. This time last week we were talking about Silicon Valley Bank, and now we're talking about Credit Suisse and what's happening there and the ramifications of some regional banks across the world. But before we get into the nitty-gritty of everything, I'd like to sort of get a bit of a background about what Stropro is, your involvement, and how you go about helping your clients.
Yeah, perfect, Chris. And thanks for obviously having me on. It's always good to share a little bit about what's happening in the fintech community, but also generally at large in the wealth management space. So Stropro, we're a curated alternatives investment platform. So when we say alternatives, we're really talking anything outside of your traditional property or equity asset class. So that includes sort of venture capital, private equity, ESG impact, even cryptocurrency, anything that sort of generate potentially non-correlated market returns and add diversification to your portfolio. I think we're big believers that alternatives can supercharge an investor's portfolio considerably. And globally, the allocation to alternatives by high net worth individuals and family offices and ultra high net worth clients is quite significant. And so Stropro was created 3 years ago to bring access to that global alternatives market here to Australia and broader APAC. And how do we do it? It's quite simple. We partner with some of the largest investment banks across the world to curate investments to our clients. And we also work with a handful of global fund managers and fund managers here in Australia.
So really, the sort of the democratization or the availability to access some of these alternative investments has been constrained in the past. And also the idea of I don't know what I don't know, the sort of ignorance, how much of it is sort of education to say who you are, what is available, and then I suppose from that point of view, getting investors comfortable to what they're investing in.
Yeah, absolutely. Education is a big part, of that journey. In fact, by 2025, according to a sort of KKR report, you'll see that alternatives are expected to be $7 trillion alone in APAC by 2025. The problem there is you do definitely need to drive education around it, particularly in a market like Australia, which the sort of penetration in alternatives is extremely low. In fact, I think it's a Premium Wealth report that came out last year or the year before in 2021 that sort of indicated that the high net worth population here in Australia have about 12% allocation to alternatives. And as I was mentioning before, the global allocation is probably closer to 52%. So the question is how do we bridge that gap? Education is a big part of it, but then also technology is an even bigger part. That means having digital, seamless access at your fingertips to these opportunities is a big part of the proposition of someone like Stropro. Traditionally, if you're a privately banked client, you would start to see a little bit of a window in these opportunities. Or if you're really on the other end of the spectrum, a large institutional client, where you have those larger ticket sizes that you can sort of bid in, that's when you start to see the access point. So we think there's a really underserved market here of clients where you've built a certain amount of wealth, you're on high income, you're already putting aside capital to invest in the market, whether accumulating or whether you're starting to, draw down income in retirement to maintain your lifestyle. Alternatives, I think, are a much more opportune way to optimize risk and return, and education and technology are going to bridge that gap, hopefully.
A couple of questions on that. One being the Australian way, we've got a pretty regulated banking system, which, in its own right probably prevent some things from happening, but also these banks pay very strong dividends. Australians have been used to income streams via fully franked dividends, and we've got the franking system in place as well. Sort of flip that on its head, go to the US. It's probably not a huge amount of focus on dividends and things like Berkshire Hathaway have never paid a dividend from arguably one of the most well-known investors in the world. Can you talk about that change of like, oh well, I've got my money in some equities, I'm getting a pretty good yield, life's pretty good, versus, oh, do I have to take some extra risk?
Yeah, look, there's two things there. One is Australia's always been known to be a high dividend payout ratio economy. The second is that the trend that you're really seeing is that dividend payout, or the average dividend yield that's being paid out, is actually falling considerably over time. Over the last decade, we've moved in that sort of higher 6%, 5 to 6%. Now, going forward, expected to be between 3 and 3.5. So what you're seeing is this compression in the dividend yield, and that's been really going to be even more impacted, I would say, by earnings of a lot of Australian companies. We're seeing this environment that we're going forward over the next 12, 18 months, I guess a suppressed equity market growth cycle, given a lot of the factors, geopolitical tension, interest rates going up, battling inflation, and let alone we've just seen, obviously, some of the recent crises that have emerged in the banking sector as sort of leading indicators that we're going into this suppressed equity market. So suppressed equity market, further earnings pressure, that's going to add more pressure to dividends being paid out to investors. And so this reliance on the dividend market in Australia, I think, is probably going to be a big question of debate. That's why alternatives play a big role. One core aspect of our business is that by working with a lot of these large global investment banks, we've been able to access one of our sort of core offerings, which are structured investments. And simply what they do is they're a combination of some balance sheet funding of a large global investment bank and another portion which is some optionality or a derivative to give you some protection against the market falling. So the combination of the two can actually generate some enhanced returns and protect you from market volatility. And that, I can tell you, Chris, is a $10 trillion industry globally, bigger than ETFs. So the fact that Australian investors don't have access to vehicles like structured investments to maintain their yield and protect them from market volatility is one of the reasons why we exist. So that's probably, there are so many other instruments you can use to kind of mitigate this kind of market scenario.
And heading into that sort of uncertain environment that you talked about, those factors that you talked about, the people are now looking for, protection and insurance. I suppose from my point of view, when the markets are up, no one talks about these sort of things, but when it gets a little bit jittery, it becomes a bit of a bit of a mechanism or a bit of an understanding about what can happen. From your point of view, are you seeing more people thinking about the idea of downside protection or using some derivatives or at least kind of some products out there to say, well, I can actually sleep a lot better at night knowing that what may come, I'm okay?
Yeah, look, I mean, it's no unknown fact that the largest institutional traders across the world have been doing this for hedge funds and institutional clients. They've been building these instruments to protect against market volatility. So why wouldn't an investor here in Australia or globally be able to access structured investments which do exactly that, right, in their personal portfolio? So to your question, we have received a lot of feedback at this point in time, which is the biggest challenge to beat at the moment is inflation. So we've seen a lot of money actually move back into safer assets. And when I say safer assets, it's really cash, term deposits, a lot of money moving back into offset accounts as well, to basically, from a risk return perspective, I'm offsetting 5 or 6% on my mortgage now, which seems like a good, healthy place to be. So I would say the risk-free rate has naturally gone up quite considerably. For an investor now to make a decision on to move out of those more safer asset classes and still get a bit of a high yield above inflation, the new return is somewhere probably between 9 and 10%. You know, otherwise it doesn't really make sense to move out of some of those safer asset classes or safer sort of vehicles, let's say, to take on more risk. It just doesn't make sense. So it's about having the balance between moving up the risk curve and what is a reasonable rate of return that you're not going backwards. And I think there's so many good solutions in the market to do that. And that's probably, again, one of the reasons why you need some institutional capability at your fingertips to do that.
You mentioned the word safe there, and another word which I haven't heard for probably a decade or so is contagion. And so, you know, the idea of what is safe and what is not safe and what's backed and what's not backed has sort of come full throttle, and the idea of sort of ramifications and contagion. You know, from your point of view, using your wisdom, you know, can you make a bit of a comment on what you think is sort of, you know, not predicting the future or anything like that, but more so about what's happened in the last couple of weeks and maybe some sort of shift in mindset from an investor point of view?
Yeah, look, I think if you look at it, we've been talking to investors about this a fair bit, but the SVB Signature Bank incident, you know, that's taken place, the regulator stepped in, shut them down. You know, it's a couple of key things. I think it's one, it's idiosyncratic risk. You know, it's poor risk management, poor treasury management on behalf of those banks, poor diversification of their balance sheet to riskier assets. And as a result, you've seen those two incidences take place. I don't think that itself was a precursor to what's currently going on with the examples of Credit Suisse. Credit Suisse, I think, to sort of comment or quote one of my other founders in this discussion was, you know, a death by 1,000 cuts. You know, we've seen actually they've had a series of AML issues over the last year. You know, several clients that they were called up on. We saw the issue, their exposure to Greensill as an example, and Archegos Capital. And then, you know, recently with the whole situation with, you know, the Saudi National Bank and the funding partner moving out, it for me is a series of events have led to this particular moment in time where, you know, we're stripping out shareholder value and a bigger bank coming in. So you might see more of a consolidation, similar examples of this, of consolidation within banking and financial services. I'm not sure if it is really the market to a bank contagion or a further financial crisis per se, but it doesn't mean we're going into a bull market all by any means. It just means that we're probably going to be in this suppressed equity market environment because if a 160-year-old institution can go through this type of stress, I can tell you there are a lot of other financial services institutions that have been around for 5, 10 years, 20 years that are going to feel the impact of things like this.
Yes, no, for sure, and it's going to pan out obviously in front of us, and we'll look back and reflect on what has happened in the last couple of weeks for a long time now. Just on your two things, one is the advancement of technology and the ability to, you know, access some of these investments, and secondly, if there are sort of funds or alternative asset classes out there which have delivered a performance over a period of time, how do they get in touch with you? And then from an investor point of view, how are you out there saying hello to the world?
Yeah, absolutely. I think there's like really two parts of the Stropro engine. One is where we work with these large investment banks on our panel. We got 7 of them currently, so 7 of the largest banks in the world. Names like, you know, Citi, Goldman's, Societe Generale, Macquarie, Texas BNP. We're soon to have 11 on the panel, and we're starting to work with a series of fund managers there in that side. And then on the other end of the spectrum, you've got wealth advisors and high net worth individuals and family offices. These two parts of the market come together, and that's where Stropro sits in between as a platform. We're there to facilitate and solve problems that exist in our investor portfolio. So in a nutshell, we could get an idea from a client who's saying, look, I need to hedge out some of my risk here in my equity portfolio. Great. We'll work with some of those investment banks to build that product, right? Likewise, There might be a wealth manager here that's going, look, we don't have any VC or private equity exposure for our clients. We would then try and source from our global network of fund managers the right opportunity to put in front of them for them to consider. And so our job is really kind of more bottom up, trying to listen to what the investor has to say to bring those opportunities here. But having said that, Chris, it's really how the engine works. I think it's been more testament to how this particular fintech has been built. Rather than just being a marketplace and a digital technology front end, which has been able to deliver alternatives, then report on them and give the comprehensive reporting, that's one big part of being able to deliver to the market. The second is having all these pipes into fund managers and investment banks. I'm not sure of any other sort of fintech on the ground that has been able to build that, but we've built this infrastructure almost to emulate what a private bank would look like in its entirety. We're also bringing some, multi-currency accounts that people can actually put their currency deposits with us. But the idea is that we've built this infrastructure which is connected into the globe, and we've created this, this elegant technology front end to be able to deliver it to the market here in Australia. But we are very solutions-based is what I'm ultimately trying to get to.
Yep.
We're here to solve problems rather than to push product opportunities in front of our investor community.
Anto, we'll wrap it up there, mate. It was nice to catch up in real life at a recent sort of Fintech Australia event late last year. There's a couple of events coming up soon. Hopefully catch up in face-to-face again and network and do all those things, because it's going to be a tough year for some of these fintechs, but also bright lights and bright shining opportunities around. So, mate, I really appreciate you coming on to the Fintech Australia podcast and looking forward to catching up.
I appreciate it, Chris. Thanks for the time, and more than welcome for anyone to get in touch if they have any questions.
Thanks for listening to the Fintech Australia podcast. I'm your host, Chris Titley. The Fintech Australia podcast is a collaboration between Fintech Australia and Sub 11. For more information about membership options, news and the events coming up, jump on to the Fintech Australia website. Have a great day. Thanks for listening, and we'll catch you next time.